Hello, everybody. Welcome to another Cryptocurrencies for Dummies. And you know what? I recorded this video earlier, but it didn't record. So here I go again. And I'm your host, Solo. And today we're going to talk about this article by Andrew Arnold that basically 30% of millennials invest in cryptocurrency. Here are 3 tips to help you do it smarter. And this is a Forbes article, by the way, for those of you who want to read. And the link, of course, will be in the description. So I'm going to read the article and then I'm going to chime in. 2017 saw a rush of capital into the cryptocurrency market, and there's no sign that 2018 will be any different. And millennials are keeping the frenzy booming. Survey conducted by Blockchain Capital, 30% of those in the 18 to 34 age range would rather invest $1,000 in Bitcoin in government bonds or stocks. The same study also indicates that 42% of millennials have heard of Bitcoin compared with 15% awareness among those aged 65 and up. In trading cryptocurrencies is hard to ignore. Yet they're not the only ones interested in this market. The competition for the coin is expected to become tougher in 2018 as new players enter the domain. It is safe to say that this year more institutional investors will start trading cryptocurrencies, especially Bitcoin. Yet, at the moment, the Bitcoin market already faces a significant supply and demand imbalance despite the high price. According to Timothy Tam, an ex-hedge fund trader and co-founder of CoinFee, an advanced market intelligence platform for cryptocurrency traders, it looks like the existing equation might force prices even higher. There's a limited supply because aside the fact there will only ever be 21 million Bitcoins in circulation, most of the holders of Bitcoin are long-term holders. The demand, on the other hand, keeps soaring, he explained. Yet Bitcoin isn't the only investment-worthy coin on the market. Ethereum, Ripple, and Litecoin prices keep climbing up as well. If you want to invest in cryptocurrencies, here are the essential tips to do it the right way. Number one, beware of the bots. Financial markets are prone to speculation. Trading is no exception. Some savvy players are now using bots to artificially inflate the coin prices and manipulate the markets. Timothy Tam points out that bots can seriously hamper your investment. In 2017, NEO, a Chinese alternative to Ethereum, went from $34 to $3.74 in a matter of seconds before returning on the $34 mark. Trading bots artificially caused a price dip, which resulted in a flash crash for a number of investors, while organizing party largely benefited from this. Spotting the trading bot, however, is a tough call. You will need to carefully watch the market trading signals and learn to notice the abnormal trading patterns. According to Tam, the two biggest indicators of a bot market manipulations are price momentum and value. As an investor, you should carefully watch these two parameters and try to notice coordinated buy patterns early on. The alternative is to use a cryptocurrency trading analytics platform that will do the watch for you. Agreed. Number two, allow your asset based on your risk tolerance. Excuse me, allocate your assets based on your risk tolerance. First and foremost, you should set a stop loss level to avoid financial collapse. A stop loss is the level of loss where the next trade will get closed. Next, keep that number in mind. You will need to build up your coin portfolio. Think of this as managing your fund. The higher percentage should be allocated to the least volatile coins, with a smaller percent given to the least stable, yet potentially higher returning currency. You should keep in mind the price correlation between Bitcoins and most altcoins to account for volatile market conditions, Tam said. What we notice at CoinFee is that Bitcoin and the majority of other coins have an inverse relationship in their value. Once there's a dip in the Bitcoin price, everyone rushes into buying other coins and vice versa. This volatility can cause serious losses for inexperienced investors. The best strategy is to always keep an eye on the market signals and use those insights to adjust your trading strategy on a daily basis. Number three, resisting overtrading and FOMO or FOMO. Tam says both novice investors and their more experienced peers are often prone to those two mistakes that come in hand. First, there's the trading FOMO, a fear of missing out on buying the new hype coin and losing some potential profits. Investors often feel urged to buy a certain coin when the price is being pumped up and up and end up allocating a lot of overhyped and often illiquid assets. Also, remember the NEO case. The price may be artificially inflated by bots, and the shining coin may quickly lose its value. Next, there's over trading, immediately selling your coins if you see a small price spike, 10 to 20%. In most cases, this could be a temporary occurrence, encouraging smaller currency holders to sell their coins before the price goes further up. Trading a certain asset just because it's in profit is not a viable long-term strategy, as it can diminish your future gain. After all, if the coin rises 10 times in price over a year, and an 80% loss will wipe out the 400% gain you have initially made. Additionally, over trading will result in a significant chunk of your assets being eaten up by exchange fees. Disclaimer, disclosure. I own some Bitcoin and Ether. This piece is not intended and should not be taken as investment advice. Okay, so good article by Andrew. Very basic. Let me just say this. In regards to number one, where he talks about the bots, unless you have a website watch this for you, or you're constantly aware of the market, you get frequent alerts. That's more for somebody who's very active in trading. Because something like that, where in mere seconds it goes down and up, you may not even notice. You know what I mean? Unless you have constant alerts. And I know that some people, they become very addictive to always checking their phones with cryptos every 5 minutes or 10 minutes. I know that I've done that at times, and sometimes I just have to shut my phone off. Number two makes an excellent point that, be smart with your investments. That's what I do. I love what he said right here when he says, next thing that you should do is the higher percentage should be allocated to the least vital coins, with a smaller percent given to the least stable yet potentially higher returning currency. And I agree with that. I totally agree with that. This is an excellent strategy. Number three. Now, number three is probably going to be more relevant, especially to novice and newbies such as myself. The fear of missing out, FOMO. I remember 2 weeks ago or 3 weeks ago when Verge was pumping, my buddy was telling me to put some money into Verge. And so, I had that fear of missing out. However, at that time, I had already bought some more Litecoin, and, the trading exchange fees, I didn't want to do it. So, but I didn't want to fear missing out either. And then, of course, Verge was pumping, it pumped up to, 19 cents, and then it dipped down to 9 cents. And I'm not sure where is it at today. But, one thing about this is that, you have to have a strategy in place, and everybody's strategy is a little bit different. My strategy, I've mentioned it plenty of times. In 2018, my strategy is going to be more focused on altcoins and getting into the lower coins and whatnot. And I'll definitely make more videos talking about my strategy here in the future. Once again, I'm not a financial guru or advisor. I'm just a guy who has invested in cryptocurrencies. I'm not a big whale or a shark. I'm just a small, everyday guy trying to get my portfolio up and, riding the wave to the moon. Anyway, this is Cryptocurrency for Dummies, and I'm out. Peace.